In this video, we will discuss the constant growth stock model as one of three different methods to determine the rate of return or discount rate on a security. For the constant growth stock model, the rate of return of a stock is D1 over P0 plus G, where D1 over P0 is the dividend yield, next year's dividend over the current stock price, and G is the growth rate of the stock, which for a constant growth stock is the same thing as the capital gains yield. For our example, we will consider a stock that dispaid a dividend $1, has a growth rate of 6%, and a current price of $30, in which case the dividend yield, D1 over P0, is going to equal the dividend dispaid $1 times 1.06 divided by 30, or 3.5%. The capital gains yield G is 6%, and therefore the total rate of return of the security is 9.533%. For a constant growth stock, you can also determine next year's price as just this year's price, or $30, times 1.06, 1 plus the growth rate. So next year, the stock will be worth $31.80. To show self-consistency, the capital gains yield has to be the difference between next year's price and this year's price divided by this year's price, and we show that 31.8 minus 30 divided by 30 is 6%. This is, again, one method of determining the rate of return of a security. A second method is the capital asset pricing model, where the rate of return of the security is based on the riskiness of the stock relative to an overall stock market. Under the capital asset pricing model, the rate of return of the stock is the risk-free rate plus the market rate of return minus the risk-free rate times the risk measurement beta. Common proxies for the risk-free rate are the U.S. government treasury bill, or a bank account rate of return. Common proxies for the market rate of return are the S&P 500 or the Wilshire 5000. A third method of determining the rate of return of a security is the own bond plus risk premium approach. In the case of bankruptcy, debt holders are paid off before stockholders. So debt is less risky than stock, but debt measures the riskiness of a company. So a possible estimate of the rate of return of a stock would be the rate of return of the company's debt plus a risk premium, maybe 3 or 4%. As a second example of the constant growth stock model, we will look at how do you use it to determine the current price of a stock. The current price of a stock is next year's dividend over the rate of return minus the growth rate. For an example where next year the stock is expected to pay $2 per share, the required rate of return is 12%, and the growth rate is 6%, then the stock price is going to be 2 times 1.06 divided by 0.12 minus 0.06, which equals $35.33. I thank you for watching this video.